What if I told you that your business could be growing, yet you're secretly losing money every single month? You might be thinking, no way, my sales are up, customers are happy, what could go wrong? But here's the truth, high sales don't always mean high profit. Many business owners, and even finance students, make the same mistake. They confuse revenue with profit, and they don't really understand the story behind their numbers. The one document that reveals that story, your income statement, could be the difference between success and silent failure. So in this video, we'll break down what an income statement really is, how to read it like a pro, and how to use it to make smarter business decisions. And stick with me until the very end, because I'll reveal a little-known profitability secret used by top CFOs that most small businesses have never heard of. Now the definition, what is the income statement? Let's start simple. The income statement, also called the profit and loss statement or P&L, is one of the three key financial statements every serious business uses. While the balance sheet shows what your company owns and owes at a single moment, and the cash flow statement tracks where money physically moves, the income statement tells a different story. It answers one powerful question: did the business make money during this period? It does that by listing all your revenues, subtracting all your expenses, and revealing your net profit or loss at the end. Think of it like this: the balance sheet is a photo. The income statement is a movie. It shows how your business performed over time, whether it's growing, stagnating, or declining. Why the income statement matters. Now, why should you care about this? Because your income statement is not just a report for accountants. It's your business's performance mirror. For entrepreneurs, it tells you, are you pricing your products correctly? Are your costs under control? Are your profits sustainable? For investors, it shows whether a company is truly profitable or just surviving on borrowed money. And for job seekers, understanding the income statement makes you stand out in interviews. Imagine being asked, how do you know if a company is healthy, and you confidently explain the link between revenue, margins, and operating profit. That instantly positions you as someone who speaks the language of business. Let me give you a real story. Fatima runs a cozy coffee shop downtown. Sales were increasing, customers loved her drinks, but every month, her bank balance stayed the same. One night, she reviewed her income statement for the first time. That's when she discovered the truth: her ingredient costs and staff wages were rising faster than her prices. She was selling more, but earning less. She adjusted her pricing and optimized her menu. Within 2 months, her profit doubled, and she didn't have to work harder, just smarter. That's the power of understanding your income statement. Breaking down the income statement. Now let's get hands-on. An income statement might look intimidating, but it's actually a logical step-by-step structure. It usually follows this order: 1. Revenue, sales; 2. Cost of goods sold, COGS; 3. Gross profit; 4. Operating expenses, OPEX; 5. Operating income, EBIT; 6. Non-operating items; 7. Taxes; 8. Net income, profit or loss. Let's unpack each one with examples. Revenue is the total income your business earns from selling goods or services before any costs are deducted. If you sell 1,000 units at $10 each, your revenue is $10,000. You might have multiple revenue streams: product sales, service fees, subscriptions, even royalties. But here's a common mistake: confusing cash received with revenue earned. Under accounting rules, revenue is recognized when it's earned, not necessarily when cash hits your account. That means if you deliver a service today but get paid next month, the revenue still counts now. Cost of goods sold, COGS. Next, we subtract cost of goods sold, often called COGS. These are the direct costs of producing what you sell: materials, manufacturing labor, packaging, etc. For a restaurant, that's food ingredients. For a software company, that's server costs and developer time. The goal is to measure how efficiently you can produce your product relative to your sales. Gross profit and margin. Now, subtract COGS from revenue and you get gross profit, the money left after covering direct production costs. Example: revenue equals $100,000, COGS equals $60,000. Gross profit equals $40,000. Then we calculate gross margin equals gross profit divided by revenue times 100. In this case, 40%. A higher margin means you're managing costs well or charging premium prices. Monitoring this number helps you spot rising costs early before they eat your profit. Operating expenses, OPEX. After gross profit, we subtract operating expenses, also known as OPEX. These are all the indirect costs of running your business, the expenses that keep your doors open but don't directly create products. They typically include rent or lease payments, utilities, administrative salaries, marketing and advertising, insurance, software subscriptions. These expenses are vital but need control. If OPEX grows faster than revenue, profits can vanish. Operating income, EBIT. Once we subtract OPEX from gross profit, we get operating income, also called EBIT, earnings before interest and taxes. This number shows how efficiently your main operations perform before considering financing or taxes. It's the purest measure of business performance. Example, gross profit $40,000, OPEX $20,000 equals operating income $20,000. Investors love this number because it reflects true operational strength. Non-operating items. Next, we add or subtract non-operating items, those that don't come from your main business. This could include interest income from investments, interest expense on loans, gains or losses from asset sales, foreign currency gains or losses. These can cause big swings in profit, but they don't reflect your core business strength. Taxes. Then we deduct income taxes, what you owe the government based on your profit. The rate depends on your country and business structure, but after this step, you finally reach the bottom line. Net income. Finally, we reach net income, or what most people call the bottom line. This is the profit left after all expenses, COGS, OPEX, interest, and taxes. If it's positive, you've made a profit. If it's negative, it's a loss. Example, revenue $100,000. Expenses $84,000. Net income $16,000. That's a net margin of 16%. It tells you that for every $1 in sales, you keep 16 cents in actual profit. Single-step versus multi-step income statement. Companies usually prepare income statements in one of two formats: KeyCap 1 single step, all revenues grouped together, all expenses grouped together, one subtraction to find net income. KeyCap 2 multi-step breaks down into multiple stages: gross profit, operating income, and net income. The multi-step version is preferred by analysts because it shows where profits are generated and lost. It tells a story, not just a number. Real-world example, 12 o'clock to 1400. Let's bring it to life with a real example. Imagine a small retail clothing store, revenue, $200,000 COGS, $120,000 right-pointing arrow gross profit, $80,000 OPEX, $25,000 rent, wages, marketing, etc., right-pointing arrow operating income, $55,000. Interest expense, $2,000 right-pointing arrow income before tax, $53,000. Taxes, 20%, $10,600 right-pointing arrow net income equals $42,400. That means for every $1 of sales, 21 cents turns into real profit. The owner can now track whether that percentage increases year after year. That's how growth is measured properly. How to analyze an income statement. Reading numbers is good, but analyzing them is where the real value lies. Let's explore how professionals interpret income statements using 3 key tools. 1. Profitability ratios. 2. Vertical analysis. 3. Trend, horizontal analysis. 7.1 Profitability ratios. Profitability ratios reveal how much profit you generate from your sales. Gross margin equals gross profit divided by revenue. Operating margin equals operating income divided by revenue. Net margin equals net income divided by revenue. These ratios let you compare performance between companies or across time. A company with higher margins usually has better cost control or pricing power. Vertical analysis. Vertical analysis expresses every item as a percentage of total revenue. Example, COGS equals 60%, OPEX equals 25%, net profit equals 15%. This makes it easy to compare different businesses of different sizes. You see where each dollar goes. Trend, horizontal analysis. Trend or horizontal analysis compares your income statement across multiple periods. Are sales growing faster than expenses? Are profits increasing steadily or fluctuating? This is how investors predict future performance. Break-even and contribution margin. Here's a bonus idea, the break-even point. It's the sales level where total revenue equals total cost, meaning you're not making or losing money. Once you pass it, every extra sale adds directly to profit. Knowing your break-even point helps you set sales targets and pricing strategies. The income statement's connections. Your income statement doesn't live alone. It connects directly to the other two major financial statements. Net income flows into the balance sheet as part of retained earnings, increasing your company's equity. The cash flow statement starts with net income and adjusts for non-cash items like depreciation and changes in working capital. Together, these three reports form the heartbeat of your business: assets, cash, and profit, all linked in one financial ecosystem. Limitations and what to watch out for. Even though the income statement is powerful, it has limitations. It's based on estimates, like depreciation or doubtful debts. It follows accounting principles, which might not reflect real cash. Timing differences, revenue might be earned before payment arrives. Extraordinary items, one-time events like selling property, can distort results. Always analyze trends over time, not just one report. Numbers mean little without context. The secret profitability trick. As promised, here's the exclusive secret that most business owners never learn, even after years in the game. Don't just stop at your total net income. The real magic happens when you break your income statement into segments, by product line, service type, store location, or even customer group. Why? Because not every dollar of revenue is created equal. Some sales look amazing on paper but quietly drain your resources. Others might be smaller in volume but generate powerful profit margins. Here's what the pros do. Step Keycap 1. Separate your sales and expenses by category. Step Keycap 2. Calculate each segment's profit margin. Step Keycap 3. Rank them using what I call the relative profit index. That's each segment's profit contribution divided by its share of total costs. Let's see an example. Imagine you sell 3 products. A, B, and C product revenue costs profit margin. A $50,000, $35,000, $15,000, 30%. B $30,000, $20,000, $10,000, 33%. C $20,000, $5,000, $15,000, 75%. Product C may bring the least revenue but the highest profit margin. That's your hidden gem. Most business owners focus all their marketing and energy on product A because it sells the most. But in reality, product C is the star that drives profitability. By identifying and scaling your high-margin segments, you can increase your total profit without selling more. That's the secret CFOs use to grow profit smarter, not harder. So, let's take a step back for a second. You now understand the income statement, not as some boring accounting sheet, but as a living story of your business. It's the movie script of how your company earns, spends, and grows. Each line tells a chapter, from how customers reward you with revenue, to how operations and strategy translate into profit. And here's the truth, most people look at their income statement once a year, only because their accountant tells them to. But the smartest entrepreneurs and top-performing managers, they treat it like a dashboard. They track it monthly, analyze trends, compare year-over-year results, and make strategic decisions before small problems become big ones. The income statement isn't just about money, it's about control. Control over your vision, your operations, and your future. And that's why, if you master this one skill, understanding and interpreting an income statement, you'll instantly separate yourself from 90% of business owners and job applicants out there. You'll know how to answer tough interview questions about profit margins, how to evaluate a company's financial health, and how to turn numbers into strategy. Remember that exclusive profitability trick from earlier? Apply it today. Go through your own income statement, or a sample one, find the hidden profit driver, and watch how one small insight can transform your entire business or career trajectory. Because once you can read an income statement like a CFO, you'll start thinking like one. And that changes everything. If you found this video valuable, make sure to hit like, it really helps the channel grow. Subscribe now for more deep dive tutorials on business finance, entrepreneurship, and smart money skills, because next week's episode will reveal, puzzle piece the secret connection between your income statement and your cash flow statement, a topic that separates profitable businesses from struggling ones. Trust me, you don't want to miss it. Thanks for watching, and remember, every number tells a story. It's time you start reading yours.